In international trade, trust between buyers and sellers can be challenging, especially when they are thousands of miles apart and operate under different legal systems. That's where payment methods and trade finance instruments such as the letter of credit or LC play a vital role. A letter of credit is a financial document issued by a bank on behalf of a buyer, guaranteeing payment to the seller, provided the seller meets all the terms and conditions specified in the LC. It acts as a safety net for both parties. For the seller or exporter, it's assurance of payment if conditions are met. For the buyer or importer, it gives confidence that payment will only be made when the goods or services meet the agreed specifications. So let's talk about the types of letters of credit. First, there's the revocable letter of credit. This one can actually be changed or cancelled by the buyer without the seller's consent. It's pretty rare these days, mainly because it carries a high risk for sellers. Then, there's the irrevocable letter of credit. This type cannot be altered without the agreement of all parties involved. And honestly, it's the most common form used in international trade. Moving on, we have the confirmed letter of credit. Here, another bank, usually one in the seller's country, adds its own guarantee of payment. Next is the sight letter of credit, which means payment is made right away upon presentation of compliant documents. And finally, there's the usance or deferred letter of credit, where payment is made after a specified period. So, how does a letter of credit actually work? Well, first, the buyer and seller agree to use an LC as the payment method. Then, the buyer applies to their bank, which is called the issuing bank, to open an LC in favor of the seller. Next, the bank issues the LC and sends it over to the seller's bank, also known as the advising bank. After that, the seller ships the goods and presents the required documents, like the invoice, bill of lading, and insurance certificate, to the advising bank. The advising bank then checks these documents and forwards them to the issuing bank. And finally, if all the conditions are met, payment is released to the seller. That's basically how it all comes together. So let's talk about some other common payment methods in international trade. First up, we have advance payment. In this method, the buyer pays before shipment. The risk is pretty high for the buyer, but it's quite low for the seller. This is most common when the buyer is new or, say, the goods are custom made. Next, we have open account. Here, the seller ships goods before receiving payment. The risk in this case is high for the seller, but low for the buyer. It's often used for trusted, long-term trade relationships. Okay, so next up is documentary collection, which includes DP and DA. Here, the seller's bank collects payment from the buyer's bank in exchange for the shipping documents. With DP, or documents against payment, the buyer only gets the documents after making the payment. And with DA, or documents against acceptance, the buyer accepts a bill of exchange and promises to pay at a later date. Now, let's talk about bank transfer, also called TT or telegraphic transfer. This is a direct payment from the buyer's bank account to the seller's bank account. It's pretty fast, but usually only used when there's a high level of trust between the two parties. So, let's talk about the advantages of using a letter of credit. It really reduces payment risk for both the buyer and the seller. Plus, it encourages international trade even between parties who might not know each other well. And of course, it ensures compliance with the agreed trade terms. Now, on the other hand, there are some disadvantages to using a letter of credit. It can be pretty expensive, mainly because of bank fees and all the documentation requirements. Also, it requires strict compliance. Even minor errors in the documents can actually delay payment. Just to wrap things up, a letter of credit is definitely one of the safest payment methods in international trade, as it balances the risks between exporters and importers. However, choosing the right payment method really depends on the relationship between the buyer and seller, the level of trust, and the cost involved. For businesses involved in global trade, Understanding these payment tools is absolutely crucial for reducing risk and making sure transactions go smoothly.